Thank you, Tom. And I do want just to remind everyone that at the end of this panel, we will have a time for questions for those of you who have questions for any of the speakers. It's now my pleasure to introduce Tom Byrne, the president of the Byrne Agency, headquartered in Wildwood with 5 locations in Cape May and 1 in Florida. Tom has served as president of the Independent Insurance Agents of Cape May County, as well as serving as the chairman of the Executive, Legislative, and Catastrophe Committee with the Independent Insurance Agents of New Jersey. Tom?
Thanks, folks. What I want to do today is kind of give you, because really most of the stuff about rates and stuff we've heard, but what I want to try to do is kind of bring it all together a little bit so you can take away kind of a thought that, like, this is how it's organized. And really, when you talk about personal insurance, which I'm going to talk about today, I like to break down the policies into 2 distinct categories. One is the policies that exist now. What's happening to those policies that people have now? And when you talk about existing policies, you can break that down into primary homes and secondary homes because they're both treated differently. So you look at the primary homes, and like the guys from FEMA said, we're not doing much with the primary homes. Your primary home, it's going to be rate neutral. It'll take rate increases when the program takes rate increases, but there's not going to be a lot to do with the primary homes. They're pretty much going to stay the same. The secondary homes really are broken down into 2 categories. It's those ones like Tom Heist talked about, the pre-firm homes that were built before the rate maps, and they've always had subsidized rates. The reasoning was, hey, at the time you built your house, you built it to the current flood insurance rate map, you built it to the rules that governed how to build your house, or before the rules were in effect, so therefore, we're going to give you a break on the rates. The other type of existing secondary homes are post-firm homes. So they're treated differently. The post-firm homes, when they were built according to the flood rate map. They had an elevation certificate. They're paying their full risk rate. The pre-firm existing policies that are secondary homes are going to see rate increases. That's where Tom was saying you're only going to see a certain percentage of homes affected by this legislation. And they're the pre-firm secondary homes. They're going to be raised 25% a year until they become full risk rate. So they're going to phase in to paying their fair share, and that's what's new with secondary homes. The other side of the coin is we have new policies that are going to be written. Either they're going to be new owners of homes, they're going to be just people that want flood insurance and are going to go out to buy it. The general guidelines with new policies are they're going to be full risk rate. So, existing policies, they get some breaks. New policies, they're going to pay full risk rates. Under the new policies, when BW12 first came out, they basically said if it's your primary home, you're going to get subsidized rates and replacement cost because we're not going to hit the primary homeowners. The rule for primary was living in your home 80% of the time. There was a lot of pushback on that, and it's since been revised. They came out with a second category saying if you live in your home over 50% of the time, then we'll call it a principal residence. You'll get subsidized rates still, but you will not get replacement cost coverage. You'll get actual cash value coverage. So there's kind of a phase-in of how much you live there and how much benefit the primary homeowner gets. The secondary homeowners, they will need an elevation certificate, the new policies, and they will go to full risk rates right away. So, in my mind anyway, you got existing policies, primaries not affected, secondaries, only the pre-firms are getting the rate increase, and then you got the new ones, the primaries, the principals, and the secondaries, and they're going to try to get them to full risk rates except for the primaries. All right, a little bit confusing, but kind of an overview. Tom talked a little bit about mitigation, and I think that's important because we see a lot of people come in. They come in with their elevation certificate, and we rate them up, and they go, "Oh Lord, that's just too expensive." And in the end, it won't be expensive for them, or won't be as expensive if they can mitigate a few things. And really, a lot of the things we see deal with flood vents. Tom talked about the adjacent ground inside and outside. Those flood vents have to be within 12 inches of that existing outside grade because the water's got to flow in through the vent and flow out through the vent. So if they're real high, the water doesn't flow in and out, so it doesn't matter. So there's height requirements. There's 1 inch of venting required for every square foot of foundation. And when we work with the people and we find out that they do have venting issues and we get those venting issues corrected, it can be a big difference in their premium. So work with your agent, ask them about mitigation procedures, and that might transfer some of the cost. One of the issues that was a real big issue with primary homes was when a home sold, and it immediately went to full risk rates, because the theory was with a new policy, a secondary home, somebody's buying a rental property down here, that was going to go to full risk rates. Well, the move now, and part of that Senate package that's been passed there, says that we can postpone that passing on the full risk rates to the new owner if there's continuous coverage. And if there's continuous coverage from the old owner to the new owner, and we just roll that policy to the new owner, the Senate thinks that we should be able to retain that subsidy on that policy and have it phase in over time, rather than going immediately to full risk. So that's a big deal, and that'll really help here. Will it help in the long run? You know, I mean, there's a lot of talk about repeal of the BW12, and eventually, I think somebody was up here and they said, eventually the program's got to get a little more self-sufficient anyway, or maybe self-sufficient. And I think the cat's out of the bag for buyers. I mean, they're not going to come in and say, well, it's repealed for 4 years, so let's go buy that house. I think what they're going to say is, how much is it going to cost me in 4 years? So I don't know if a repeal really does it. And as insurance agents, I don't know if we're going to be able to tell them what it's going to be in 4 years if it's repealed. If it's in effect and we know what the plan is, we'll be able to tell you, yeah, it's going to cost you this much. If it's off the table, then we just don't know the state of it. So there's pluses and minuses to that. Lapses. Last thing I'm going to talk about. Lapses are going to be very, very important. With the advent of the continuous coverage burden on sales, it's going to be really important for mortgage companies. It's going to be really important for flood insurance policyholders to pay their flood insurance and make sure they don't have a 30-day lapse, because if they do, they need an elevation certificate and they're going to full risk rates. So it's a big deal to have a lapse. And that's it.